Hi students, in this lecture recordings, we are going to discuss the balance part of our uh, budgeting topics. Right, this is the activity we have to discuss. We need to start from this activity, balance part. The previous session we covered uh, the other parts, right? Okay, activity number 8.3. I think you are given with this activity. You are given summarized statement of financial position of Saleh PLC as of 31st December. Then you are given the statement of financial position. These are the actual information that you extracted from the Saleh PLC's statement of financial position. This information you can consider when it comes to prepare your budget for the next period. In addition to this actual information, you are given some other information uh, with respect to sales. Company forecasted sales for the first half of the year like this. January, you expect to sell 2000 units, February 2000 units, March 3000, April 4000, etc. Right? Then it is said 20% of the monthly sales on cash basis and the balance part 80% on credit basis. Right? That means out of these 2000 units, 20%, that is 400 units on cash basis, and balance part 1600 units are expected to sell on credit basis. And when it comes to pricing, you have two different pricing policies. For the cash sales, your price is 600 rupees per unit, credit sales 800 rupees, and material and labor requirements. You can see direct material per unit, you need 2 kgs, and cost per kg is 75 rupees. And you need 1.5 hours in making 1 unit labor, and labor rate per hour is 120. And manufacturing overhead cost is absorbed based on direct labor hours. Absorption rate, overhead absorption rate is 80 rupees per labor hour. And these are the non-manufacturing overhead cost related information. Variable selling expenses 20 rupee per unit. Then fixed cost per month. These are non-manufacturing overhead costs, right? You know, non-manufacturing overhead costs are generally charged to P&L. So you can see selling expenses, variable expenses 20 rupee per unit, and admin distribution and depreciation expenses are also there, right? So these are fixed costs. Fixed admin cost 25,000, fixed distribution cost 15,000, depreciation that is relating to non-manufacturing overhead cost per month 10,000. Then stock policies, raw material stock policy. A stock of raw material equal to next month's production requirement will be maintained. That means when it comes to maintain your stock balance, you need to have a stock balance which is sufficient to meet the next month production requirement, right? We'll use this information in latter part of our activities. At the beginning, we need to have an overall understanding about the question. So this is the raw material stock policy. You need to maintain a raw material stock equivalent to or sufficient to meet the next month production required. Then when it comes to finished goods policy, finished goods equal to the requirements of next 2 months sales. It means at the end of each month, you need to maintain closing stock, closing stock of finished good which is sufficient to meet the next 2 months sales, right? Don't worry, we will be using this information when it comes to do the activities, right? Then work in progress, there will be no work in progress, so it is, you don't need to worry about that. Then purchase and sales condition, payments of raw material is to be made on average 2 months after the delivery. That means, Lamai, when you purchase a raw material, let's say you purchase raw material this month, you are not going to pay make the payment same month. You pay after 2 months. So if you purchase January, you will be making the payment not January, not February, in March, right? So that's how payment is made for the purchase of raw material. When it comes to sales, we know, uh, right, 20% cash basis, 80% credit basis. Out of those credit sales, right, you make a credit sales. Out of the credit sales, 50% is collected in the same month, and 30% of the credit sales collected in the following months, and 20% of the credit sales will be collected, right, 2 months after the sales. Then these are the other payments related information. Direct wages are paid during the month which they are incurred. Direct wages means wages, right, relating to the manufacturing people, or people directly engaged in the manufacturing process, right? Those direct wages we pay in the same month. Usually, Lamais, salaries and wages we paid in the same month, otherwise they can't run their life, right? So direct wages we pay in the same month. Manufacturing overhead cost includes manufacturing overhead cost includes annual depreciation of, right here, annual depreciation of machinery 120,000, right? Manufacturing overhead cost, we know manufacturing overhead cost is absorbed using overhead absorption rate. In that manufacturing overhead cost, it is said 120,000 annual depreciation is available. So accordingly, monthly depreciation included in the overhead absorbed overhead cost should be 10,000, right? Because this is annual depreciation. Then fixed overhead cost incurred equal fixed overhead cost is incurred in equal amounts each month, and is paid in the month in which it is incurred, right? There are other fixed overhead costs. Those fixed overhead costs are paid in the same month they are incurred. So don't worry, we'll be using this information when it comes to uh, discuss the relevant part of the activity, right? Then income tax. Income tax for the quarter ending 31st March is expected to be paid. Estimated is 40,000 and is paid on 31st March, right? Then further, income tax payable at the as at the 31st December 2020, let's say, paid in January 2026. Right. If you look at the my balance sheet, they must have income tax payable here. Income tax payable. This is as at December 31st December. This income tax will be paid in the January month. That is the month coming under your budgetary period, right? So when it comes to prepare the cash budget for the January, February, and March, so this amount will be paid in the January month, right? Then then all the other manufacturing and non-manufacturing overhead costs are paid during the same month. If there are any other manufacturing or non-manufacturing costs, they are paid in the same month. Right? Usually these payment related information are usually relevant when it comes to prepare your cash budget, right? So we'll be using this information uh, right in the latter part of this activity. It is expected to sell trade investment and its market value is 250,000. We have trade investment. It is said we sell this trade investment during January at a market price, market value of 250,000. Let's look at the balance sheet whether we have trade investment. Yes, we have trade investment of 200,000. This trade investment is sold, disposed during the month of January for 250,000. That 250,000 will be coming under cash budget as cash receipt. At the same time, there will be a profit from disposal of this investment, which will be coming to the P&L as well. Okay, Lamai. So these are the basic information relevant for this question, right? Um, that's it. So we will now move on to our sales budget. Now my sales budget, sales budget shows the number of units you expect to sell and sales income that you expect to generate during the budget period, right? So accordingly, let's see how to prepare sales budget using this information, right? All this information will not be relevant when it comes to prepare sales budget. Sales budget is a very uh, straightforward and very simple budget. We are now starting from the sales budget and we'll be then going to discuss rest of the operational budgets. We'll start from the sales budget, right? So these are the information that are directly relevant for our sales budget. It is said January month we expect to sell 2,000, February 2,000 units, March 3,000, April 4,000, May 6,000, June 8,000, right? Now you are asked to prepare budget for the 3 months. So according you need to focus only on 3 months and your budget should clearly show January, February, March and total column. Usually, when it comes to prepare budget for monthly basis for 3 months or quarter, end of the last column should show the total column. So let's see how to prepare sales budget. Okay, this is our uh, sales budget format, right? Sales budget January, February, March total, right? So this is our basically budget, right? Okay. So number of units to be sold. You expect a number of units to be sold is 2,000, 2,000 and 3,000. So we'll put it in 2,000, 2,000 and 3,000, right? So let me to delete this. Okay. So the first you put the number of units. Then sales. These are units, then sales value. We know we have two types of sales, cash sales and credit sales. And if you again look at the information, you can see 20% on cash basis, monthly sales will be cash basis, 80% credit basis, right? 20% cash basis, 80% credit basis. And cash selling price is 600, credit selling price is 800. So we can accordingly find out what is the cash sales. Cash sales is equal to how much? It is said 20% cash sales. That means the number of units you sell multiply 20%. I put 0.2 20% multiplied cash selling price 600. Cash selling price 600. Then credit sales equal, this is the total number of sales multiplied 0.88% credit sales multiplied selling price, credit selling price is 800 and this is your cash sales for the month of January and credit sales for the month of January. And you can do the same thing for the rest of the part. I can copy this, but you can't do it if you do it on a piece of paper, right? So this is how we prepare the uh, sales budget. Now you can put, if you want, you can put the total number of sales in terms of units, 7,000, and total sales in terms of cash, this much, and this is your credit sales, right? So, Lamai, this is your uh, sales budget, sales budget. And if you want, sometime you can see this section gives you sales units information about April, May, June. This information, Lamai, may be required when it comes to find out your closing stock requirement. Can you remember? Here it is said, right? Stock requirement here, finished goods. Finished goods equal to the requirement of next 2 months sales. Next 2 months sales. According to this information, right? These April month sales and May sales would be relevant when it comes to decide how many units you need to maintain at the end of March, right? So according to this information now, relevant, right? But it is not relevant for your sales budget, but you can consider this information when it comes to latter parts. According to my advice, sales budget is all this, right? Uh, is your sales budget. Uh, but if you want, you can put those information as well in your activity. This 4,000, 6,000, and 8,000, 4,000, 6,000, and 8,000. So this information you may consider when it comes to right other parts of your activity, right? So this is your sales budget. You can see it is very simple and straightforward, right? Very simple. Okay, let's now look at the next part. Uh, Next part, prepare the sales budget for the first 3 months. We did it, right? So you can see this is the answer, right? This is the answer. I do hope you understood it. Next, uh, so this is my what are the right when it comes to forecast demand, what factors you need to consider. So these are the some of the factors you need to consider, right? Okay. Then let's move on to prepare the production budget. Okay. Okay, we'll now prepare production budget. So let's see what is production budget. The production budget shows the expected number of units to be produced with a specific future period. Right? You can see the production budget shows the expected number of units to be produced within a specific period of time. Right? Okay. So accordingly, based on the information given in activity 8.3, prepare the production budget for the first 3 months. Now my production budget, right? What does it show you? It shows you the expected number of units to be produced. Okay, let's now see how to prepare production budget, right? Okay, right. Lamai, now you know your sales requirement, right? You know your sales requirement, right? For the month of January, you need to sell 2000 units, right? Right. Lamai, in the production budget, we are going to show how many units should be produced. How many units should be produced. Now, how we decide? So, what are the factors that determines number of units to be produced? Basically, right, let me to 43 months, January, February, right? The number of units to be produced depends on your sales requirement. So one of the key important factor that decide the number of units to be produced is your sales requirement, because your production must meet your sales requirement. So accordingly, we need to first consider these information, right? January month, we need to sell 2000 units. Or let me to link it. January month, we need to sell 2000 units. February and March, we need to sell 2000, 2000 and 3000. So accordingly, we must produce, right, a particular number of units which, which meet the production requirements, sales requirement. Your production requirements or production output must meet your sales requirement. So accordingly, you need to sell 2000, right, in January, 2000 in February, 3000 in March. In addition, in addition to your sales requirement, Lamai, if you produce only the number of units equal to the sales requirement, let's say you produce only 2000. If you produce only 2000, what will happen? You produce 2000 and all 2000 is sold, then there won't be any closing stock. So accordingly, you can't merely produce sales requirement, sales requirement. In addition to sales requirement, you need to produce your closing stock requirement, right? You need to produce first to cover your sales requirement. In addition, you need to produce to maintain your uh, closing stock. So accordingly, closing stock policy. So what is our closing stock policy? Right? You can remember we had stock policy. Here, finished goods. Finished goods. Finished goods equal to the requirements of next 2 months sales will be maintained. You need to maintain finished goods equivalent to next 2 months sales. It means, it means you need to have, you need to have um, closing stock equal to the equivalent to the next 2 months. So this is your next 2 months. So you need to produce accordingly. Accordingly, this month, right, February month sales requirement, demand, and the March demand. So you need to produce this many units. So accordingly, you need to produce 2000 to meet the sales requirement. In addition, you need to produce 5000 to meet the closing stock. Accordingly, is it 7000 your production requirement or production budget? No, because you have open stock. You have open stock. How do you say you have open stock? Go to your balance sheet. In your balance sheet, you can see stock, raw material, and finished goods. Finished good, you have 4,000 finished goods, 4,000 units of finished good is available, right? You have finished good units of 4,000 at the beginning. So accordingly, since you have finished good of 4,000, you can deduct this 4,000. Accordingly, you only need to produce this many units. You need to only produce 3,000 units. 3,000 units, right? Lama, if you want, you can uh, put this sales requirement first, thereafter you can add closing stock requirement, thereafter you can deduct opening stock if you want, right? But here the opening stock has been deducted in the second line, right? No harm. This the accordingly amount you need to produce. So you can see, Lamai, your sales requirement 2,000, but you produce 3,000. Why? Because you need to produce not only to maintain sales requirement, but also to maintain your closing stock requirement, right? Sales requirement 2,000, closing stock requirement 5,000, all together 7,000, but we don't produce 7,000. Why? You have, at the beginning, you have open stock, you deduct it, then you need to only produce 3,000. Likewise, right? So this closing stock will become open stock for this period. May closing January month closing stock will become open stock for February, right? Then uh, February closing stock, February closing stock, right? We notice what is the company's closing finished good stock policy. They need to maintain next 2 months sales requirement. So this is March sales requirement. You go right. This is March sales requirement. This is April sales requirement. So accordingly, February month, for the February month closing stock should be right equivalent to March demand units and April units. So accordingly, closing stock for the February month is equal, I say, March stock, March sales requirement plus April sales requirement. Okay. Accordingly, what is the production requirement? 4,000, right? 4,000. Then this closing stock will become open stock for the March, and March closing stock should be equivalent to March closing stock should be equivalent to next 2 months demand sales requirement. Next 2 months sales requirement is 10,000. So accordingly, it is this plus this. So this our closing finished goods. So this closing finished goods, Lamai, should be appeared in your balance sheet or statement of financial position that you prepare for the quarter ending 31st March. So this is your closing stock. This should go to your balance sheet. But don't forget, right? This is your unit information. This should be, right, convert into value. That part we'll discuss later, right? These are units. In terms of units, we have 10,000 number of units, but in the balance sheet, we need to put the value. And accordingly, This is the number of units we need to produce. So we can now see this is your production budget, and we can now see the number of units to be produced. Right. So this is your production budget for the 3 months. So this is needed. So this part I'll delete for the time being. Right. So this is your production budget. So we will now see what is our next requirement. Prepare the production budget. Yes, this is the production budget, right? According production requirement, take a 3,000, 4,000, and 6,000, 6,000 production requirement. 3,000, 4,000, and 6,000. Then prepare the direct material usage budget and material purchase budget. Okay. Now we prepared sales budget. Based on sales budget, we prepared production budget. Based on production budget, we can prepare my material usage budget. For you to produce your goods, for you to meet your production budget, you need to have sufficient raw material purchase, right? So accordingly, uh, based on your production budget, we can decide what is the material usage requirement. Thereafter, code, right? What is the number of units to be raw material to be uh, purchased from each different types of raw material, right? Luckily, I think in this activity, we have only one type of raw material. Sometimes there may be two or more raw material, in which case, uh, like there will be additional rows involved, right? Okay, right. The purpose of preparing material usage budget is to identify the required units of each material. Material means each raw material, right? Each raw material to produce the production requirement. The purchase of the purpose of preparing direct material purchase budget is to determine required number of units of each material to purchase, right? So these are the uh, general explanation. So according to we will now prepare material usage budget and material purchase budget. Okay, this is the production requirement. And material usage budget. Material usage budget lamai is very simple and straightforward, right? Material usage budget. Look at your activity information. You can see material and labor requirement. Direct material requirement is what? Direct material usage per unit is 2 kilograms at a rate of 75 rupees per kg, right? So accordingly, each and every unit we produce, we need 2 kilograms of raw material. So accordingly, we can identify material usage requirement. Material usage requirement. Material usage is equal. Now, since your production requirement is this much, this many units, you are going to produce this many units, 3,000 units to be produced, and we know for each unit we need 2 kilograms of raw material Accordingly, this is your usage requirement. For you to produce 3,000, you need 6,000 raw material. For you to produce 4,000, you need 8,000 raw material kilograms. For you to produce this 6,000, you need to have 12,000 kilograms of raw material. Then less. Now this is the usage requirement, right? Usage requirement. Then based on usage budget, we can decide how many units to be, how many units of raw material to be purchased. We need 6,000 raw material for the production requirement. We need 8,000 for the month of February, 8,000 raw material, kilograms of raw material just to meet February month production. We need 12,000 kilograms of raw material just to meet March production requirement. But in addition, similar to the way we thought when it comes to uh, production budget, you can't simply purchase this many raw material. Why? If you purchase 6,000 raw material, what will happen? If you simply purchase 6,000 raw material, end of the period, your raw material stock balance will be zero because you purchase only 6,000, all 6,000 used for the production. Then you won't have any closing stock. So accordingly, we need to have raw material sufficient to production requirement plus which is also sufficient to your closing stock requirement. So what is the closing stock requirement? Right, closing stock requirement. Let's go and see your stock policy. Raw material. Stock of raw material equal to stock. This is the raw material stock policy. A stock of raw materials equal to next month production requirement will be maintained. You need to have closing raw material stock. Your closing raw material stock, in addition to purchase of 6,000 kilograms to meet the production requirement, you need to have some right raw material in your stock. Your closing stock requirement is what? Your closing stock requirement should be equal to next month production requirement. So it should be 8,000. Next month production requirement, right? According to my right, we know as far as January is concerned, January month is concerned, January month, for you to meet the production requirement, you need to purchase 6,000. In addition, for you to maintain your closing stock, which is equivalent to next month production requirement, 8,000 should be maintained. But you don't need to purchase 14,000. Why? Right? Because you have open raw material. You have open raw material stock balance. Go and check it in your balance sheet. You have raw material stock of 4,000 kilograms. 4,000 kilograms is there. So you have open raw material of 4,000. So open raw material, since you have open raw material, you don't need to purchase all 14,000. You can deduct the open stock. So you just need to purchase 10,000 kilograms of raw material. Number of units. This number of units means my number of uh, raw material units, right? Number of raw material units. Units in the sense kilograms, right? Right. So accordingly, we prepare the January month, right? Material purchase budget, right? Usage we can easily decide. We need this production requirement 3,000, 4,000, and 6,000. So based on production requirement, usage requirement per unit 2,000, 2 units per finish 1 unit of finished good. We need 2 units of raw material. So accordingly, material usage requirement, sorry, 6,000, 8,000, and 12,000. Um, our closing stock policy is we need to maintain sufficient number of closing stock of raw material which is equivalent to the next month raw material usage. Okay. So accordingly, this closing stock will become open stock. This closing stock will become open stock for this period. And for this month, February month, we need to maintain closing stock of raw material sufficient to the next month production requirement based material usage. It is accordingly 2,000, sorry, 12,000. So this will become open stock for the next period. And March, for the month of March, closing raw material for the month of March, closing raw material should be based on April month production requirement. So accordingly, we need to prepare April month production requirement. April month production requirement. So we need to do that part, right? Because you need to find out for you to find out March closing raw material since it is based on next month. Next month means April. April month we need to prepare April month production budget and April month uh, material usage requirement. Okay, so April month we can go into find out this information. April month sales requirement 4,000. April month sales requirement 4,000. Here 4,000. April month closing stock. April month open stock should be equal to April month open stock should be equal to closing stock of this one. Then closing stock. April month closing stock. So what is the closing stock policy? Closing stock policy. Have a look at closing stock policy for the finished goods. We considered earlier. Finished good equivalent to the requirement of the next 2 months sales. Next 2 months sales. So next 2 months sales. Next 2 months sales means May, June 14,000. May, June 14,000. So accordingly, closing stock requirement 14,000. Accordingly, production requirement for the month of April is this much. This is the production requirement, 8,000. For to meet this production requirement, usage requirement should be how much? Usage requirement, this is the number of units to be produced during the month of April. For to produce 1 unit of finished good, you need to have 2 kilograms of raw materials. Accordingly, usage requirement is 16,000, right? 16,000. So closing stock requirement means sufficient to this amount. So accordingly, our closing stock should be equal to this amount. So accordingly, our number of raw material to be purchased for the month of March should be 16,000. So accordingly, this is your number of units to be purchased for each month. For the month of January, we need to purchase 10,000 kilograms. February, we need to purchase 12,000. March, we need to purchase 16,000 kilograms of raw material, right? So you can see, we cannot purchase only the raw material sufficient to meet production requirement. Why? We need to have closing stock. So we need to purchase raw material which is sufficient to meet the production requirement and closing stock requirement. But since we have open stock, it can be deducted. Then we can find out the number of units to be purchased. So according this line represents number of units to be purchased. Number of units to be purchased. And we know, sorry, we know the purchase price. Purchase price per unit of raw material. 1 kg cost is 75 rupees. Secondly, we can find out the purchase cost. Purchase cost. Purchase cost. Purchase cost is equal this times 75 rupees. 750,000. And this is your uh, purchase cost budget, right? We need to purchase raw material for 750,000 for the month of January. For the month of February, we need to purchase raw material for 900,000. And for March, we need to purchase raw material for 1.2 million. So this is the purpose of preparing direct material usage budget and purchase budget. So this represents usage based on production, we decide usage based on usage and closing stock requirement and open stock after the adjusting open stock, we decide the number of units to be purchased and by incorporating or adjusting with the purchase price, we decide purchase cost budget, right? Okay. Right. So, so we can put total column for this total purchase for the budget period of 3 months. Then this we can say purchase cost, purchase cost. Okay, fine. So this is our direct material usage and purchase budget. So we have shown here usage. Actual usage we got by multiplying this by considering this production. If you want, you can incorporate production requirement. Production requirement we got from this point. Production requirement raw material per unit. Raw material per unit 2 kg, 2 kg, 2 kg, right? So accordingly, this equal this times this, right? So that's how we got it, right? Okay. So this is our material usage budget. Based on production requirement, we decide the usage material usage requirement, and by considering the closing stock requirement and adjusting for open stock, we decide the number of units to be purchased. So this is our purchase requirement, and by adjusting the price, we can decide lamai purchase cost. So sometime you can incorporate purchase price like this, because this for this activity price we expect to remain constant, right? So you can say price, sometimes price may be changing, right? So in which case you can put the price like this 75, because in case if the price is going to be changed, right, uh, that price should be adjusted here, and then this equal this times price, and this is our total purchase cost, right? Okay. So these are my material usage budget and material purchase budget. Next, material usage. Prepare the material usage budget and purchase budget based on the given information given in 8.2. Right, that's what we prepared. Okay, these are our material usage budget: 6,000, 8,000, and 12,000. We got it here, right? 6,000, 8,000, and 12,000. So this is material usage budget, and based on this we prepare material purchase and purchase cost budget, right? Usage budget, uh, then material direct material purchase budget. So we can see purchase cost is given here, uh, right? There's no additional column for price, but you can understand sometime price may be uh, vary for each month, or price may you may expect to change the purchase price, which case you need to incorporate price in this separate in a separate row applicable to separate month, right? This case we no need to put price in a separate row, why price is constant. Okay, next, prepare direct manufacturing labor cost budget. Direct manufacturing, no need to say manufacturing, Direct manufacturing labor cost no need. Let's say prepare direct labor cost budget, right? Prepare direct labor cost budget. So let's now prepare direct labor cost budget. Uh, right, based on, let's say, production requirement, production requirement we already decided. Direct labor cost based on the production requirement, 3,000, 4,000 and 6,000. 3,000, 4,000 and 6,000 production requirement. Then labor hours, it is say, let's go and check in labor hour requirement. You can see direct labor hour per unit 1.5 hours required and labor cost is 120. So according labor hour requirement equal production requirement 3,000 units to be produced and labor hour requirement is 1.5 hours. 1.5 hours. Accordingly, for the month of January, production requirement 3,000, labor hour requirement accordingly 4,500. Why? Per unit we need 1.5 hours. For February, 4,000 production requirement per unit 1.5 hours according to 6,000. For March, accordingly 9,000 labor hour requirement. So this is your labor hour requirement. And then labor cost, rate per hour, rate per hour, rate per hour this case 120, which is going to be constant. So you can just put 120 in case if labor cost is expected to increase by 30 rupee per hour during the month of March, then here it should be 150 labor rate, right? But this case it is same, right? So you can put it like this. Then labor cost is equal number of labor hours 4,500 multiplied by labor rate per hour 120, this much. Now this is your labor cost budget, right? So total labor cost accordingly, uh, this much, right? Right, you can see production requirement, labor hour requirement, rate per hour, right? Direct labor cost budget. Based on the information given in 8.3, prepare the direct manufacturing labor cost budget, right? So this is it, right? You can see 3,000, 4,000, 6,000 production requirement multiplied by 1.5 hours, right? Then labor hour requirement this much at 120, this is your labor cost. Next, we'll prepare manufacturing overhead cost budget. Manufacturing overhead cost budget. And manufacturing overhead cost, usually Lamai we decide based on predetermined overhead absorption rate. You can see here, manufacturing overhead costs are absorbed into the product based on direct labor hours, and absorption rate is 8 rupee per direct labor. So accordingly, my overhead absorption rate is 80, and accordingly we can decide direct labor, sorry, manufacturing overhead cost budget. Manufacturing overhead cost budget using overhead absorption rate. Okay, manufacturing overhead cost budget. So direct labor, how to decide? Direct labor we already computed. Our requirement is 4,500 for January, and for February 6,000, March 9,000. Right here we already computed. Then we know overhead absorption rate is 80 rupee per hour. So accordingly, manufacturing overhead cost for the month of January should be this many hours times 80 rupee, this much. According total is this much, 1,560,000. Right. Manufacturing overhead cost budget 360, 480, and 720, altogether 1,560,000 manufacturing overhead cost budget. Next, prepare the non-manufacturing cost budget. Non-manufacturing cost budget means, you all know, non-manufacturing costs are the costs that are charged to the P&L. Non-manufacturing costs generally we charge to P&L. So what are the non-manufacturing overhead costs we usually find? We find in them in the P&L, usually coming under the different headings such as selling expenses, distribution costs, administrative expenses, and other uh, expenses. Right? So accordingly, you are asked to prepare non-manufacturing cost budget. So whenever you see non-manufacturing, you need to understand it is relating to admin, sales and distribution, marketing, other expenses, right? Okay. Uh, then, based on the information given in 8.3, prepare the non-manufacturing overhead cost budget, right? So let's see what are the information given here. Non-manufacturing overhead cost, variable selling expense. Selling expense is non-manufacturing cost budget, cost, non-manufacturing cost. 20 rupee per unit. Selling expense 20 rupee per unit. Okay. So right. So variable selling expenses 20 rupee per unit. So how many units we sell? We sell this many units times 20 rupee. So accordingly 40,000. And for the 3 months, it should be right like this, right? Variable selling expenses, you can see if you want again, variable selling expense 20 rupee per unit. Per unit 20 rupee. So we sell January month we sell 2000. 2000 times 20 rupee 40,000. February also we sell 2000 units, 2000 times 20, 40,000. March we sell 3000 units, 3000 times 20, 60,000. That's how it came like this, right? How I computed it like this. I directly link to this units multiplied by 20 rupee, right? 20 rupee. Then I drag it to rest of the part like this. So accelerating may not, but if you do it in a manually, you should multiply them separately and add it here. Okay, this is variable selling expenses. You know these are coming to P&L as expenses. Next, fixed cost per month. Distribution 15,000, administrative 25,000, depreciation 10,000. Distribution, admin, depreciation 10,000. So this depreciation lamai non-manufacturing depreciation, right? Non-manufacturing related depreciation. Okay. Again, look at it. How much? Distribution, admin, and depreciation. Distribution, admin, and depreciation. Amount 15, 25, 10. These are fixed. 15,000, 25,000, and 10,000. And these are same to rest of the 3 months. Right? So these non-manufacturing overhead cost budget. If you need, you can add the total column here. Right. So these are non-manufacturing expenses. These should go to P&A. Right. Okay. So this is your non-manufacturing expenses. Non-manufacturing expenses. Okay. Then prepare the cash budget. Now my cash budget is very, very simple. You need to carefully do it, right? Preparation part is very simple, but you need to carefully do it. Uh, Prepare the cash budget, right? So let's prepare the cash budget for the month of January, February, uh, and March. Okay, right. In the my cash budget means simply your cash account, right? Okay, let's see what are the cash flows. In the cash budget, you simply show your cash flows. Uh, and this cash budget, you don't need to follow the uh, cash, this cash budget, you don't need to follow the, it's very simple. You don't need to classify them as operating activities, investment and financial activities, right? This simply you just list down cash receipt first. Cash receipt you first list down. Thereafter you list down your cash payments. Difference between cash receipt and payments, you can uh, call it net changes in cash. Then to this cash balance changes, you add your open cash balance, then you can find out your closing cash balance, right? Okay. So let's see. So what are the cash inflows to the firm, to this organization, to this business? Main cash flow is coming from sales. Main cash flows are coming from its sales. And sales are two types. There are cash sales and credit sales. So from cash sales, we already found, right, cash sales. You can see this is your cash sales. So these cash receipt should come to your, right, this cash receipt should come to your cash cash budget, right? Let me do put this in a separate. This should come to your cash budget. So accordingly, this is your cash budget. Cash received from cash sales, January month, we received this much of cash from cash sales, 240,000. Then I can drag it to next 3 months. Accordingly, January month, cash received from cash sales 240, February 240, March 360. Go and check 240, 240, and 360. Right? So this is cash collection from cash sales. In addition, we have credit sales. We have credit sales. So these credit sales, from these credit sales, we collect cash. We collect cash, right? So that collection from credit sales should be separately identified, right? So you can uh, prepare a separate schedule to find out cash collection from cash collection from credit sales, right? So let me to put it, I'll put it on a separate sheet, right? This working is very important, Amai. Let's say schedule of collection from credit sales. So we'll first put, let's say January, February, March. credit sales. Now my January credit sales, how much? This much. 1,280,000. February 1,280,000. March 1,920,000. Right? Yes. Okay. Now let's see their collection policy. Collection policy. You can see Lamai. Debtors will pay their dues as follows. Debtors means right our customers. They will settle their due amounts 50% of the credit sales in the same month of sale. 30% of the sales will be paid in the following month. 20% will be paid in the after 2 months. Right? So we can say my 50%, 50% same month, 30% following month, 20% after 2 months. Okay. Equivalent this 1,280,000 Berlin out of this 1,280,000, right? We will collect 50% in the same month. January month we will collect 50%, 0.5, right? So total my January month we will collect this much of cash out of this, and out of this 1,280,000, 1,280,000, 50% same month, balance 30%, no, right? Out of the balance 30% will be collected in the February month. So you can say this multiplied by zero point 0.3, right? Out of this 1,280,000, 50% same month, same January, right? Another 30% February, and balance 20% will be collected. Balance 20% will be collected after 2 months. After 2 months. And when it comes to this 1,280,000, again 50% will be collected same month, and 30% will be collected in the following month, and balance will be collected somewhere April, right? This times 0.2, April, right? April. Right. So you can see these are our cash collection, right? Okay. Then as far as this March sales are concerned, 50% will be collected same month times zero point 0.5 same month. Balance 30, right? 30% will be collected, 30% will be collected April times and balance 20% will be collected somewhere here. May, the month of May. Right. So these are your right debtors receivable in your balance sheet. Right. So these out of our sales, we collected cash like this, and this many credit sales are due at the end of March. So May tika will be collected April and May. That means these are receivable at the end of March. So these are your closing debtors. Right. These are your closing debtors. So these are our cash collection. Lamai, in addition, so these are our cash collection. In addition, we have Lamai open trade receivable. You can see we have open trade receivable, debtors, open debtors, sales of November. November sales වලින් out of November sales වලින් receivable තියෙනවා 256. Out of sales made in December, we have 600,000. So November sales, December sales වලින් receivable තියෙනවා. So these receivable must have been collected during this period. November sales, December sales. This is not November total sales, right? Out of the November sales, remaining receivable is this much. Out of the December sales, remaining amount is 600. So these amount must have been collected during the current period. 256 and 300. According Lamai, so let's put November and December. So these are not credit sales, right? 256 and 600. Lamai, this November sales, right? After, right, will be fully collected January. Why? November sales Lamai, this 256 November sales represents now after 2 months, it will be fully collected. So we are in January, November sales will be fully collected. Here we can put 256. This December, now I think about these 600,000 coming from last month sales. That means last month credit sales should be somewhere around 1.2 million. That information is not needed, right? December's credit sales should be 1.2 million. Why? Because 50% is collected then and there December. Credit sales should be 1.2 million. 50% collected then and in the same month. So 600,000 collected. Out of this 600,000, 30% will be collected this month. 30% will be collected. I'll put it here. 30% will be collected here. 30% will be collected here. Uh, so December month, 600,000. This represents 60, this 600,000 lamai represents now 50%. Why? December month sales volume. Already December month we could have collected 50%. So this represents balance 50%. So out of balance 50%, uh, we need to get uh, we can't take 30%, right? This from this it's mathematics, it's maths, right? I say this this represent lamai now 50% of the dates. Out of the 50%, you need to take right 30%. So accordingly, it should be uh, uh, let's say 60%, right? Max I'll explain later, right? So this times point 6 360 this because this is not 100%, this here you have 50% of data, right? 100 වලින් 30%, 50% වුණාම 60% එනවා. 100 වලින් 20%, 50% වුණාම ළමයි 40% එනවා, right? Like that. Point 4. Right. Accordingly, ළමයි these uh, open credit sales, this open debtors receivable, this is how we collect. Now my November month sales, right? November month sales sold in line. November month itself we collect 50%. December month we collect how much? Now think only about this November month sales, right? We don't know what is the November month sales, right? Debtors arising from November month sales, right? Now I'm explaining this one, right? Debtors arising from November month sales. 50% is collected November month itself. Balance 30% we may have collected December month. So balance must be collected in January. So that's why this 256 I put here, right? Okay. Then December month we have 600,000. If you are not okay with mathematics, now think it like this. December month sales has a result in 600,000 closing debtors. Lamai December month sales volume, you must have collected 50% in the same month, 50% in the same month, and this should be the balance 50%. Accordingly, December month sales should be how much? This is the balance, and you should have collected 600,000 same month. Total, let me just put it like this. Total sales should be, if you are weak in mathematics, right? Total sales for the December month should be 1,200. 50% is collected in the same month, in the December, right? It is not relevant for us. Making 50% we must have collected. Then balance part, balance part balance part 30% should be collected January. Then from this 20% collected should be collected February. So that's what I have put it like this. It's simply right, simple mathematics, right? Okay. So accordingly, now we can find out cash collected from trade receivable. This is very important. You need to carefully prepare this, right? So this is not a part, directly part of your any of the answer, but this working is a must for you to prepare cash budget. If you are not asked to prepare cash budget, this schedule is right not important, right? Okay. So let's see cash collected during the month of January, February, and March from uh, trade receivable. right? So these are the only cash collection, right? Don't take these big figures, right? These big figures you don't need to take, right? Okay, I'll put uh, two figures. Okay, then cash collected from trade receivable this much. Why we only consider cash collection, right? We don't add this one, right? You can see only this part. I'll apply separate color. These are cash receipt, right? 1,256,000, 1,264,000, 1.6 million. These are the cash collection, right? Okay, right. So we can take this information to our cash budget. Cash budget. Where's our cash budget? Right. Cash receipt from debtors. Cash receipt from debtors is this much. Okay, then you can see, right, this company mainly generate cash flows from ordinary business operation, collection from debtors and cash sales. And if you look at the information, it is said company has one more cash inflow, that is from sale of investment. You can see it is expected to sell the trade investment. Its market value 250,000 during the January. So January month we sell our investment for 250,000. So we can take January month 250,000 cash received from sale of investment. So these are the only cash flows that we can expect to generate during the month of January, February, and March. So let's now see payments. Payments. And when it comes to payments, Lamai, uh, these are the payment related policies. Direct wages are paid during the same month in which they are incurred. So, what are the right salary payments we usually make? We have one of the main payment, that is payment for direct labors. So, we have already prepared the direct labor cost budget. So, this our direct labor cost budget. We need to pay it in the same month. We can't delay it. That means in the same month it is incurred. So direct labor cost budget is this. We can pay it like this. Then manufacturing overhead cost. Manufacturing overhead cost. Can you remember my we incurred manufacturing overhead cost? We we absorb using overhead absorption rate. Manufacturing overhead costs are absorbed into the production based on direct labor hour this much, right? But it is said when it comes to latter part, right? You can remember manufacturing overhead cost includes annual depreciation of 120,000. So manufacturing overhead cost we absorb using absorption rate. Out of that amount, right? Annual depreciation is 120,000 is available, included. So monthly, right, depreciation included in the overhead absorption is 10,000. So you know my depreciation is not a cash outflow. So accordingly, we need to remove depreciation of 10,000 each overhead from each month under overhead cost. So let's look at manufacturing overhead cost. This is our manufacturing overhead cost budget. Like this we decided by using overhead absorption rate. We already prepared this, right? And it is my 10,000 included, 10,000 depreciation included. It is said, you can see, it is said manufacturing overhead cost includes depreciation of annual depreciation 120,000. So monthly depreciation is 10,000. So we can consider, right? So this overhead cost, right? Overhead cost, and out of this overhead cost, 10,000 is depreciation. It is non-cash expense. So accordingly, our overhead cost should be 360,000 minus this. For the February, 480,000 minus this. For March, 920,000 minus this. So this for your working, right? Not the part of your, this is not the part of your answer. Answer in the sense may, or it cost. Uh, I'll put you, right. So accordingly, manufacturing overhead cost is equal. This is total manufacturing overhead cost, which include depreciation this month. So accordingly, I take 350,000. So it should be 350, 470, 710. Then variable selling expenses. Variable selling expense we computed. This variable selling expense, we can drag it here like this. Distribution expenses, we can put it like this. Administrative expenses, we can put it like this. And this depreciation, this is non-manufacturing depreciation. Anyway, depreciation is not comes under cash budget. Then tax, you can remember we read the question in full at the beginning. Income tax payable at the beginning of the period. We can see income tax for the quarter ended 31st March 40,000, which is paid end of March, and beginning payable amount is paid January. So accordingly, it is said income tax for the March for the quarter, which is paid in March 40,000. So we'll put income tax paid in the March 40,000, and beginning payable amount that should be available in our balance sheet. Income tax payable තියෙනවා 31st December, it will be paid January 30,000. So you take it to our cash budget as a payment 30,000. Uh, and it is said proposed dividend, proposed, it is expected to pay the proposed dividend during February. Proposed dividend it should be paid in February. So let's see in the balance sheet. Here we have proposed dividend. This is paid in February. This is paid in February. I think proposed dividend paid in February. How much? 50,000. Then there's another important payment, Lamai, that is payment to suppliers, right? Payment to creditors, and suppliers. Payment to creditors or suppliers also we need to carefully uh, find, right? The way we computed collection from our trade receivable, payment made to creditors. So let's look at creditor settlement policy. Here, purchase selling condition. Payments for raw material is to be made on average 2 months after delivery. After 2 months, right? We make the payment. So let's see our right purchase. There is our purchase budget. This is sales budget, material usage, and this is our purchase cost budget. You can see, man, this is our purchase budget. These are purchase budget. So let me take this to our calculation. This is schedule of collection from debtors. Schedule of payments to creditors. So this is our right. We'll put credit, credit purchase, credit purchase. These are purchase budget, right? Okay. Credit purchase. Sona 59 and 1.2 million. Sona 59 and 1.2 million. So these are our credit purchase line. And let's look at the open credit purchase. Open creditor balance from the balance sheet or statement of financial position. We can see, Lamai, under current liabilities, creditors, right? Supplies of November, right? We have 300. December we have 375. 375. November 300. December 375,000. So what is our policy? Our policy is, Lamai, after making credit sales, credit purchase, we settle after 2 months. So this particular credit purchase will be settled in January. So this is our uh, payments. This particular November month credit purchase will be settled after 2 months, January. this particular December month credit purchase will be settled 2 months after delivery, right? Not January, this month, right? So this January month credit purchase will be settled 2 months after delivery this month. Okay, so these are all of my cash payment to creditors. This we paid January, this we paid February, this we paid March. These two will be right, will be paid coming month. So these two, right, this will be settled April, this will be settled May. So accordingly, these are our closing creditors. These are our closing creditors. Balance should be coming on the balance sheet. These are closing creditors. It is not relevant right now. And this is our payments to creditors. Payment to creditors. Payment to creditors accordingly 300, 375, 75 and 750. So let's take it to our schedule. This is our cash budget linked to this. Right. Then my right. So here we have cash receipt, right? Cash receipt total. January month collection from debtors this much, February this much, March this much, cash from collected from cash sales this much. For the month of January, we have 250,000. It is not 25,000, it is 250,000 sale of investment and total cash collected, cash received for the month of January this much, February this much, March this month. And we'll put right. And this our cash payment lamai. We put cash payment. Now we can find out total cash payments like this. Total cash payment. And the difference between cash receipt and cash payment we can find, right? We can call it changes in cash. Changes in cash is equal this minus this, right? Okay, then to this lamai we can adjust open cash balance. Open cash balance. Okay, now lamai here I think we have made a mistake here in the direct labor hours and manufacturing overhead cost, right? Here you can see direct labor cost. We have referred to a wrong sales, right? Direct labor cost and manufacturing overhead cost seems to be the same. So let's go and check direct labor cost. So direct labor cost budget should be 540, 720 and 1,080, right? So we have referred to as wrong sale, right? Direct labor cost budget is here. Manufacturing direct labor cost budget. It should be this 540 should be drag it like this. Right now it must be correct. Right. So accordingly, we have change net cash change like this. We got net cash change like this for 3 months, right? Then open cash balance. Now think about one particular month, January month. January month, we have cash received this much, total cash payment this much, cash net cash received this much. To this, we just add open cash balance. Open cash balance is available in your balance sheet. Here you can see cash and cash equivalent 644. So you can go and add 644,000. Then you can find out closing cash balance. This closing cash balance, this closing cash balance lamai will be equal to next month open cash balance, right? Then open cash balance plus this, you can receive the closing cash balance. This closing cash balance will be equal to next month open cash balance. Then this plus this will be your closing cash balance. So this is the cash balance that must be available in your balance sheet that you prepare at the end of the period for the right for the quarter ended. If you are required to prepare the right, if you are required or if you are asked to prepare master budget including P&L and the balance sheet, this cash balance must be appeared in your balance sheet. Okay, Lamai. So that's it. Then prepare the cash receipt and cash discount, cash budget. You asked to prepare cash budget, we prepared it. And so this is the cash budget. So we'll check the closing balance 1,090,000. 1,090,000 and 179,000. 1,090,179 is correct, right? So our calculation is correct. So this is the suggested answer. Prepare master budget, that is budgeted P&L and budgeted statement of financial position. Okay, Lamai, now you have all the tools, all the figures required for you to prepare balance sheet and P&L. Right, balance sheet and P&L. So now, for example, since you have prepared the cash budget, cash flow statement, all the transaction we have considered, and you can simply prepare your uh, budgeted balance sheet and budgeted P&L. So, for example, uh, you can have a look at your statement of financial position. This stated capital and reserves will be adjusted for the profit or loss that you are going to like generate for the 3 months. These creditors will be replaced by, right? These creditors will be replaced by your creditors, right? Be prepared to my creditors, right? These two creditors are the creditor balance, right? Payments of creditors. These two creditors represent your creditors, 2.1 million. And these debtors represent your these debtors represent your 1,216,000. It represent your trade receivable, right? So using this information, right? Using so accordingly, you have all the required information for you to prepare your balance sheet and P&L. So according to my uh, so you have trade receivable here, trade payable here, and from the cash budget, you have cash balance. You have cash balance 179,000 that is coming in the right balance sheet. And what else? This we have income tax payable is not there in your balance sheet because we fully paid it. Open payable we paid, right? And the quarter ending 31st March also we fully paid. Dividend proposal, no, right? All settled. So in your balance sheet, you must have trade payables plus stated capital and reserves, right? That will be adjusted, right? Should be adjusted for the profit or loss you incur, right? You generate for the 3 months. Non-current asset should be subject to depreciation. Non-current asset, right, should be subject to depreciation. We have 30,000 depreciation for the 30,000 depreciation for the manufacturing overhead and another 30,000 depreciation for the non-manufacturing overhead. Can you remember it? Here depreciation, this is non-manufacturing depreciation. 10,000, 10,000 and 10,000. 30,000. In addition, can you remember manufacturing overhead costs also include 10,000, 10,000, 10,000 depreciation. Altogether, depreciation 60,000 should be adjusted from your balance sheet. From your balance sheet. From the balance sheet, 60,000 should be deducted. Then raw material, right? This stock balance not available. You can find out the stock balance from your uh, schedule, right? Schedules you prepare. And debtors, we mention what is the debtor balance. This is not there. Debtor balance should be taken from your collection schedule, remaining balance. Collection schedule, remaining balance. Likewise, my that part it's up to you to do it, right? You by using these answers and information, you are required to prepare the balance sheet and the P&L, right? It's up to you to do it. Okay, my that's it. So I will stop this recording and I will upload another recording for standard costing, right? Okay, Lamai. If you have any concern about any of these clarifications, right, let me to show the answers, right? Show the answers for the P&L and the balance sheet. Then you can compare your answers with the suggested answers. So this is my budgeted statement of 5 P&L sales, open finished good, manufacturing cost minus closing finished good, cost of sale, then gross profit. Uh, right? We sold 200,000 worth of investment for 250,000. That is sale profit from sale of investment 50,000 and expenses. Uh, Variable selling expenses, distribution expenses, admin expenses, and depreciation. This is my basically I told you P&L basically comes with this amount, right? You can see 140, right? Non-manufacturing budget, non-manufacturing cost budgets basically comes to P&L. Sorry, admin, sales and distribution, admin, depreciation, non-manufacturing related. Okay. So what is the amount? Total like a 140, 45,000, 75,000, 30,000, right? 140, 45, 75, 30. That's 140, 45, 75 and 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 30. That's 1 what appeared here 140, 45, 75, and 30. From gross profit plus 50,000, you deduct this non-manufacturing cost. Then you have profit before tax this much. Tax expense at the same time we paid this, and this is your profit. Now this profit 690 should be added to your stated capital and reserve, right? So according to your uh, budgeted statement of financial position should be something like this. This is your asset. From the asset you deduct depreciation as I explained earlier, and stock balances you can take from your prior workings we prepared. Then debtors, we have this much of debtors. Then and cash balance 79,000. State capital and reserves, you can now see it has been changed. Original value plus 690. And creditors, you can see 90,000 and how much? 120,000, 1.2 million. Creditors, 90,000 and 1.2 million. Okay. Right. Right. That's it, Lamai. So the suggested answer for the statement of financial position. And this is the suggested answer for the statement of P&L, right? So this is statement of P&L and balance sheet. Uh, combine all the operational budgets, all the functional budgets, and you prepare a statement of P&L and a statement of financial position, right? So this is suggested answer for the P&L. This is suggested answer for the statement of financial position, right? Okay, Lamai, thank you very much. So I'll upload a separate video for recording for standard costing. Okay, thanks. Thank you very much.